If you have at least 50 full-time equivalent employees at your organization, that means you're considered an applicable large employer, or ALE for short. ALEs are subject to more regulations than smaller businesses, especially when it comes to offering health benefits. One requirement that ALEs have to follow when it comes to health benefits is the Affordable Care Act's Affordability Requirement. This ensures your employer-sponsored health coverage is affordable to your full-time employees. So how do you know if your health coverage is considered affordable? And what happens if you don't offer affordable coverage? We'll answer these questions in this video and more to help you stay compliant. But before we dive in, be sure to subscribe to our channel so that you're the first to know when we drop important health benefit updates like this. Now let's talk affordability. First, what does the affordability requirement actually require from ALEs? The affordability requirement represents the highest percentage of an employee's household income that they can be expected to pay for their monthly health insurance premium to be considered affordable. This is based on the least expensive employer-sponsored plan offered by an organization that meets minimum essential coverage. This requirement was put in place to make sure that employees have access to affordable health coverage through their employer. For 2022, the affordability requirement is set at 9.61%. So that means in order for a plan to be considered affordable, employees can't be expected to pay more than 9.61% of their household income for their health coverage. But how are you supposed to know what your employee's household income is? Well, thanks to safe harbors, you don't have to. Because employers have no way of knowing what their employee's household income is, safe harbors were put in place as benchmarks to help employers determine if their plans are affordable. The most commonly used safe harbor is the Federal Poverty Level Safe Harbor, or Fpl Safe Harbor. The Fpl Safe Harbor gives employers a maximum premium amount for employee contributions for that year. For 2022, the Fpl Safe Harbor dictates that an employee must pay no more than $103.14 a month in order for their health plan to be considered affordable. So as long as employees aren't paying more than $103.14 a month for their premium, the plan is automatically considered affordable according to ACA standards. You can also calculate affordability based on your employee's rate of pay, which is the hourly wage rate multiplied by 130 hours per month, or for salaried employees, 9.61% of the monthly salary as of the first day of the 2022 coverage period. So what happens if you don't offer an affordable health plan? Well, you've got two options. You can play or pay. If you choose to play, that means you'll increase your employer contributions so your health plan is considered affordable with the requirements. This is your best option if you can afford to increase your contributions and want to avoid any potential penalties for not offering affordable coverage. If you choose to pay, you won't start offering affordable coverage and instead potentially pay a penalty for not offering an affordable plan. Let's talk about those penalties in more detail. While all ALEs are legally required to offer affordable coverage, only a select few are actually subject to penalties for not following the rules. Penalties are given only to organizations that have more than 30 full-time employees, not full-time equivalents. So if you have 30 or fewer employees, you may choose to continue offering the plan you have, even if it's considered unaffordable, without suffering any consequences. However, if you do have more than 30 full-time employees, there are two penalties, also known as shared responsibility payments, enforced by the IRS. One penalty, known as the A penalty, is enforced if you don't offer MEC to at least 95% of your full-time employees in any given calendar month. The penalty is triggered if at least one of your full-time employees receive a premium tax credit to help pay for coverage through an ACA marketplace exchange. This penalty is currently $225 per month, multiplied by all of your full-time employees minus the first 30. However, this penalty is expected to rise when the IRS makes its annual updates. The other penalty, known as the B penalty, is enforced if you offer coverage to at least 95% of full-time employees, but each full-time employee was not offered an option of minimum essential coverage that was affordable and provided minimum value. This penalty is currently $338.33 per month for each full-time employee that receives subsidized coverage on the ACA Marketplace Exchange. This penalty is also expected to rise once the IRS makes its annual updates. For ALEs, paying attention to regulations like these is essential to ensure you're offering an affordable plan so you avoid hefty penalties. If you offer an HRA with PeopleKeep, we stay on top of all the relevant regulations that impact your health benefits to make sure your plan is always compliant. Our award-winning customer support team helps thousands of organizations administer their own HRA every day, and we'd love to help you too. Tap below to subscribe and get more health benefit updates like this. If you're interested in an HRA for your organization, visit peoplekeep.com to learn how we can help you get started.